It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group.
Hey, welcome back. Welcome. Another edition, another episode, podcast time. Managing Your Financial Future. Johnny Dean, your podcast host, not an advisor, but sitting here with the advisor, Professor Rick Plum, certified financial planner, professional. Professor, welcome back again.
Thank you, sir. Thank you.
Yeah, it's really nice. We're in our new studios, which are our podcast studios. As I said last time, they're pretty well done. But I don't know if you can hear this. I can hear this in the background. They're building our TV studio downstairs and next door, and the drilling is like loud.
Yeah, there's a hammer drill or something going on in the background.
Something going on. I have. What do you need to drill over and over and over?
Well, outside they're jackhammering as well, so we can hear that at times as well because they have to. Well,
the jackhammer isn't too bad. It just seems like there's some type of pneumatic drill or something.
Yes.
Next door. So
new space. You have to grow with it, and it's not quite done yet.
You do.
They're building out the TV studio. And then they're also finishing the rest of the client experience area downstairs for the clients that want to come and see us in the office.
Yes, and it's going to be great when it's done.
When people can actually start traveling again.
That's right, which who knows when that's going to be. But anyway, so if you start hearing some drilling sounds in the background, apologize for that now. There's nothing we can do about it. We'll just carry on.
Well, I guess we could come in at midnight and do these, but okay, so there's nothing we can do about it.
No, probably not. Not going to happen. This is sort of a new beginning for us. We have new studio, new podcast studio, some new equipment going in. It's a new year, a relatively new year, depending on when you happen to be listening to this. And we've got some new folks listening. And one of the questions we had, remember an episode or two ago when we started season 8, I think it is, I said that people wanted to know something about us and something about you and me and how we all got started in this particular business. So I want to just address that for no other reason than to satisfy people's curiosity and to get to know us just a little bit better. We've been doing this podcast for, I don't know, a few years, 8 seasons, whatever a season is. But we've also been doing radio, television. I go back almost 30 years with this, and you go back a good 25. But there are still some people who don't really know what this is all about. I mean, for the new listeners, they may just think, well, who is this guy, Professor Plum? Who does he think he is, calling himself a professor? So I want to I
didn't give myself that name. That was given to me by somebody else.
Yeah, are we going to say who that was? Was that just obviously it's from the game Clue?
Well, I don't know where he came up with it because at first, when we started using the term professor, Plum was not allowed to be used. We had changed radio stations.
That's right.
I was the financial editor with a previous radio station, so they couldn't use my name during the show, on the new show.
Yes.
So I was being called the professor.
I remember
Professor
that.
Plum.
That's right. See, I'll throw the call letters because who cares anymore? KFMB. We were at KFMB. You remember that?
Yes.
In San Diego, AM 760 KFMB. You were Rick Plum.
Yes, I still am Rick Plum.
You were Rick Plum on the air. But then because you were the financial editor, when you moved to, I think it was KSDO.
Yes.
Across town, they were big rivals at the time. You could not call yourself Rick Plum, right?
We couldn't use my name on a rival station. The show that we did every day was on KSDO, the rival, but I was still doing business reports 6-8 times a day. Had to get up at like 3:30, 4 o'clock.
On KFMB, right?
On the other radio station. That lasted about a year. We're doing both of them.
Yeah, it's not going to work.
But during that time, they couldn't use my name on the show, and so they were going to call me a lot of things. Some things the FCC probably wouldn't have allowed, but the answer man, but that was taken, and other things. They just when we did our first show, Ray was talking about, and we're going to have the professor of finance here to teach everything about finance. And I'm thinking, man, I lost my job already.
No, you are
and then he's like, the professor is here.
The professor. And so you became just the professor. And then after a while,
and then once I left the other station, quit getting up at 4:30, 3 o'clock in the morning, we could use my name, but there was this kind of a stigma, or who is this professor guy? So the name was only slowly introduced, and so that's when they started calling me Professor Plum.
There was a mystique, and then it
that
became
came
Professor
obviously
Plum.
from Clue,
yes.
which a game I've actually never played.
I think I saw the movie once. I may have played the game once as a kid, but I know nothing about it. But anyway, so you became the professor, and we call you Professor Plum, because not because you're tenured or anything. Although after all this time, you probably could have been. But let's go back. Let's go back a little ways. How many? I mean, what was your first job? It wasn't in finance, was it?
Well, my first real job, other than mowing lawns and things.
Yeah, we all did that. But yeah,
paperboy. Back when they had paper boys.
You and me both, and we called them paper boys.
Yeah, I was a paper boy. I was almost 12 when I first started.
What paper were you delivering?
I started with the Daily Californian.
Wasn't it the El Cajon Californian at the time? Because it was the El Cajon Californian.
I remember the Daily Californian.
But then it became the Daily Californian.
I'm a couple years older than John, and so yeah, I remember it always being the Daily. But what do I know?
Well, it was
a long time.
But anyway,
it was in my day.
It was the Californian, which was the sort of cheaper version of the San Diego Union.
Yeah,
and then the Union,
and it was
and
an
then
afternoon.
The Tribune. Yeah,
I subbed for a friend of mine on the morning paper for the big one, the Tribune.
Yes,
and realized I don't like getting up that early.
No,
and so I went for an afternoon route.
Yeah.
But that caused its own problems because then I'd have to race home from school, get the papers, fold them, put them together, do my route, and then go to baseball practice, football practice, whatever was happening at that time of the year, and then homework. Oh yeah, that was a long day.
It was a long day. And did you have the pouch? You had the pouch, right?
The front and back.
Because you took your bike.
Oh, I was on a bicycle. Yes.
Right. So we had the front and back, and I remember I learned very quickly: don't take all the newspapers out of the
rotate.
front because you wind up choking when the back of the
right. And I had a very hilly route.
Well, we lived in a hilly area.
Yeah, and I remember that I got really pretty good shape riding that bike up and down those hills, carrying that pack of, I don't know how much the packs weighed, 40, 50 pounds maybe?
They seemed heavy. We had to put all our own newspapers together. We had to fold them, had to put the rubber band around them, put the inserts in. If it was raining, you had to put the little plastic. So,
but there's no paperboards anymore. Because back then we were independent contractors, and they don't allow, at least in our area, they don't allow them to be independent contractors.
Well, the
anymore.
last I saw, if I'm out running early, there's a car that goes by,
right.
and they, for the few people that still get the paper.
We have a car that goes by in my neighborhood, but it's not like the Tribune or one of the big papers. It's a advertisement paper that everybody picks up and throws away without even opening it.
So Paperboy, you also did, I think, some grocery work.
I was a grocery clerk for a long time, but that didn't happen until I was in 17 years old, give or take. Yeah. I did 10 years. Talk about your tenure. I did 10
Rick
years.
Rick did 10 years.
I did 10 years for frozen food clerking. But I was 10 years at a grocery store. I have a monthly pension when I decided to start it.
Isn't that great? I know. How much is that? Like $150 a month?
I think it's maybe almost $300 a month.
Yeah, okay,
65.
That's something.
Hey, it's better than nothing.
It's grocery. It's groceries, as I always say. So you did that.
Before I did that, I worked in a very high-end men's clothing store for a while.
The Highlander?
Yes.
We fit the San Diego man.
Oh
man.
Yeah, I started that when I first got my driver's license.
I can't imagine you. I've seen the way you dress sometimes.
That's because I can't afford the things that I know what's good. I just refuse to pay for it.
So you did that.
I did construction cleanup where I would go in. I didn't do any actual skilled anything. It was a matter of I was a gopher, for the guys doing the work. Yeah. I need to move that stack of wood over here so we can grab it. Oh, somebody spilled some nails over there. Pick them all up and put them away. And I found out very quickly they had me dig a brow ditch one day.
What's a brow ditch?
When there's a slope, they've cut into a slope, and then above the slope cut line, they build a ditch.
Oh, to keep the
water goes in there rather than coming down.
Hence the name. Okay.
And I found out very, very early that that was not for me.
No,
I mean that's hard work.
So then you went off to college at some point.
I was in high school when I had all these jobs. And I worked for a stereo store, installing car stereos at the time, late 70s, mid to late 70s.
Mad Jack's?
No, it was a small, not one that you would know. And I mean, now I'm trying to think of everything. And then when I was in college, I started the grocery store in high school, continued with the grocery store. I worked overnights, mostly like 11 o'clock till 7 in the morning, or sometimes 3 to midnight. But that meant I had most of the days so I could go to school. But I would set my school up to be Monday, Wednesday, Friday, or Tuesday, Thursday. And on the days where I didn't have school, a lot of the times I would drive a delivery truck. So I was a delivery driver for a couple days a week doing things while I was still doing the nighttime thing. It wasn't always the best idea to come off of an 8-hour shift, getting off at 7 in the morning, and then go drive a 24-foot delivery truck. But you got to do what you got to do when you.
Isn't it amazing the stamina we had back then?
I have. I work for a large RV lot at a dealership, but I didn't work for the dealership on the lot doing sales or anything like that. I would help them rotate their stock from Arizona to California at times. So I would take a RV rig from California, San Diego area, over to Yuma or Phoenix and pick up a different one there and bring it back here. Yeah. Or one time they flew me out to Colorado to pick up a rig that had been repoed and drive it back from Colorado. And so I enjoyed that. That was fun.
None of that was related to finance, though.
Well, no. I was in school trying to figure out what I wanted to do at that time. And trying to,
as we all were.
And I had always thought that I was going to be an accountant because I was decent with numbers. I mean, math does not scare me unless you get into the trigonometry, the crazy stuff.
E to the x, dy, dx, calculus.
Yeah, I mean, that regular math doesn't scare me.
Actual numbers, yeah.
And financial math made sense to me. Always liked money. I mean,
yeah,
I can say that. So I always thought accounting, and my uncle was an accountant. He seemed to have a pretty good life, and he was a smart guy. I enjoyed talking with him, and so I always thought I was going to be an accountant. But it took me a little while to go to school. When you're working 2 and 3 jobs, school doesn't always happen easily. So it took me a little while, and while I was going through it, I was an accounting major. I got into my junior year of accounting, took cost accounting. I think it was the final, and it was like, oh my gosh, I can't do this. It was so exacting, so tedious, so specific and I couldn't figure out why they were being that. I'm sure there's reasons for everything an accountant does, but it was a little bit just too rigid. And so I thought, so I switched over to economics, still in the idea of money and things of that nature.
Yeah.
And as exacting as and as perfectly that accounting is, economics is all theory. And there was no absolutes. Accounting was all absolutes. Economics was no absolutes.
So you were floating.
I was just trying to figure out. I got to find something I want to do.
But you kind of knew it had to do with numbers or money. It was going to be
with numbers and with money. And then I took an elective at the university I was going to that had to do with learning about the basics of investing, stocks, bonds, cash, things of that nature, learning the basics of insurances, of healthcare, of learning the basics of taxes. And I thought, what a great elective. They figure the people in college are going to be making some money. They're going to need to know a little bit about how to handle. That was back when, at least in high school, they taught you how to balance a checkbook in the day. So I figured they were just trying to teach young students how to handle their financial money that they were ultimately going to make as college graduates. And what it really was the very first course in the CFP, Certified Financial Planning curriculum. So it introduced me to a career that I'd never even known about before. It was at the time there were 6 courses, and this was basically an overview of those 6 courses. And I thought, this is a career? This is cool. I really like this. And so I then changed my emphasis. I'm a finance major, economics minor with emphasis on financial planning. They didn't have a true financial planning degree at that time. They added that a couple of years later. But so everything after, then all of a sudden, I was taking more classes. Before I was kind of taking a couple classes here and there, stringing myself along. Now I got a purpose. And I was able to finish up fairly quickly after that. But it was by accident that I found an elective that was actually introduced me to a career that I've had since college.
So it sort of played to
my strengths.
Your strengths of figuring out, putting pieces of a puzzle together, but at the same time using numbers as the
accounting
base. Yeah.
To as much as I wanted to use accounting, and I still do okay with accounting. I mean, but I'm not going to do cost accounting for a manufacturing company. Still using economic theory and things of that nature, but building it all together and helping people.
It was as practical as what it was.
Yeah.
You could say, here's a goal I'd like to have. Can I get there from here?
And how does this work? How do the numbers work to function and to make sure that it works in your favor? Or how can you make it less stressful in some respect? Right. Sometimes it's not going to work in your favor.
Yeah.
You just have to find a way to make it work as much as possible. I mean, it's frankly,
so you graduated with what? What was the actual degree then?
Finance with an emphasis on financial planning.
Finance with an
or
emphasis
financial services, but
okay.
Yeah,
I didn't even know that existed.
It was just an emphasis. I don't. Yeah. My actual degree says finance.
So you went into financial planning right after that?
Actually, before I graduated, I was still working at the grocery store. I was still driving trucks, a couple days a week, and I was figuring I'm going to have to transition out of this somehow. And so I looked at the job wanted board at the in the business section at the university, and there was a financial planner that wanted help, somebody to do office work. Figured, what the heck? I got to learn this stuff. And so I interviewed for the job and took the job. And it was actually just a couple buildings down the street from where we are today.
Really?
Yeah. It's just right off the freeway.
Like where we're sitting from now.
Right now. Yeah.
Right now. Wow.
Yeah. And I worked for him, and I realized you don't sign on with somebody in their 60s, a single individual owner of a business that's in their 60s, because they retire. I'd worked for him for about a year, and he decided to retire. I was in nowhere strong enough yet to be able to buy out his business or do anything. So I'm basically without a job.
Now you're jobless again.
But he was able to set me up with a interview with somebody who really liked who I was and what I could do, but they didn't need me at the time. He set me up with somebody else. And I got very lucky on that interview because I called the president of the company that this gentleman had given me the name of, went through the secretary or the assistant associate, whatever you want. And I said, this is Rick Plum for so-and-so.
Yeah. Well,
they were waiting for, the president of the company was waiting for a phone call from a CPA named Rick Blum.
No way.
Uh-huh. And so when the person who took the call said, this is Rick Plum for so-and-so, they put me right through.
And you're talking to the president of the company?
Now I'm talking to the president of the company. Whereas if it had not been, they had not been waiting for that call, wow, I would have been screened off, and I would have maybe not gotten it. And so I got him on the phone, and he quickly realized I wasn't who he thought it was. He's like, well, you got me. Give me your pitch. And so I said, here's what I'm looking for, yada, yada. And so I went in for an interview. He hired me. And that was with a bigger company.
Yeah.
That was in 1988.
Yeah.
And so I started doing financial planning on a larger scale at that point for multiple people within that organization, being their backbone.
And that's kind of where you learned some of the stuff.
I learned a lot. They had two offices, one in San Diego, one in San Clemente. And the gentleman that ran the financial planning of San Clemente ran the financial planning division of this large financial services company. And he was a great teacher. And I learned a lot. I saw a lot of different types of entities. I saw, people that were starting Roth IRAs, or not Roth IRAs, but before Roth IRAs, starting traditional IRAs. I mean, back then the limit was $2,000 a year.
Yeah.
And I also saw people that, had the worldwide patent to, like the flush toilet. I mean, they had money.
Yeah, right.
And we did a lot more estate planning and things of that nature back then. But I saw a wide range because I didn't work with just one advisor. I was support for multiple people doing background research and doing things.
Yeah, and you were learning about all this stuff.
I was learning a lot.
And then at some point, you went on to what became Lucia Capital Group down the line, which is where you are now.
A manager that was with the firm I was at the time left us, worked with Lucia Capital Group, the company back then, and Ray was just getting into the radio at the time and said he needed somebody at the office that could be the go-to resource because he wasn't there as much. And so the manager who I used to work with, who was now working for him, said, you got to talk to Rick.
And
so I talked to, I got the job, and that's where I've been ever since.
And you've been, so it's been a long time. Since 93. Right. And I've been associated since 91, but I remember when you came on and we brought you on to the actual radio show.
I was with the company for about 3 weeks.
A week, yeah.
And then they said, okay, Rick, you need to show up at the studio at this hour.
You're going,
and
huh?
I was like, okay.
So here's the thing.
I actually planned on doing.
We talk a lot about bucket strategy on this show. And the bucket strategy about that time.
It was 93, 94-ish where the idea of the buckets came out.
When the idea of buckets came out, and you took a look at that, and see, at that point, you were fairly well versed in financial planning. having only been in the you'd learned enough at that point.
I've been in the business 6 years or so at that time.
To understand, to look at things with a critical eye, because you do that a lot. You looked at things with a critical eye. You looked at the bucket strategy as it was being developed and as it kind of came out in 94, 93, 95, whatever it was. And you took a look at that, and at some point, obviously, you had to have said, this really looks kind of good.
The traditional way of financial planning, where you use a balanced approach, it works a lot of the time. It works well a lot of the time.
A balanced approach meaning?
You have a balanced portfolio. You take
60-40 mix of
60-40,
stocks.
70-30, and you just take a systematic withdrawal from that portfolio.
And then rebalance?
And then rebalance it back to your 60-40 or whatever and you have one big portfolio that represents everything. And you take your draw from that portfolio, a balanced portfolio, which sounds nice, and it works a lot of the time. The problem is when it doesn't work. And every once in a while, it doesn't work, and it doesn't work at all. Now, we saw this happen several times in history. And then for a while when we were doing and I thought, well, the buckets strategy, it won't grow to the moon when the markets are just on fire doing the greatest work of their lives. But it works in those bad years that we can't predict when they're going to happen. And I will tell you that, through the late part of the 90s, our overall performance lagged because we were
using buckets
because we were being a little conservative. We were setting up a distribution bucket. Now, back in those days, we could get, safe guaranteed money, guaranteed by the FDIC, guaranteed by large insurance companies that were paying 4 and 5%, 6% guaranteed money.
Mm-hmm.
Can't get that anymore. But I remember we were on the air and we're listening to one guy talk that was on a different show, and he was saying he takes his safe money and he just puts it in the QQQ, a NASDAQ ETF. That was where he put his safe money.
Right, and I remember that because I was there, and this was like
1999.
Early 2000, late 99, early 2000.
And so for the 95 to 2000, early 2000 range, a balanced approach or a pure .com approach worked awesome. Right up until about March 20th of 2000.
March 10th, I think
March 10th,
it was. Yes.
Right in that. That was about when you bought. Never mind.
It was, yes.
But then it didn't work for a long time after that because the market took a huge downturn in March of 2000 and took years to recover. And by the time it recovered, then people started getting excited again. And then it dropped again in 2007, 2008 to 2009. So we needed a plan that worked regardless of what the market was doing. Good times, bad times. And so that's where buckets really comes into play. Now, it is not a set it and forget it. The balanced approach is very easy. You can have a computer rebalance it. You can, set it up and be done with it and never have to look at it again. At least that's what they say. But it really hurts when the markets go down. When is the market going to go down again? I don't know. It could go down and stay down. Now, we had a downturn 2 years ago, but it didn't stay down for very long.
No.
Is that the wave of the future? I don't know. Or was it going to be more like the 2000 to 2002, a 3-year downturn and a 6, 7, 8, 9-year recovery?
What did you see in buckets all those years ago, though? Because you've been using this strategy
since 93, 94.
You haven't abandoned it. In fact, you've strengthened it in many ways.
I saw that it worked. And I didn't have to be Nostradamus to be able to predict when to get somebody out of the market because nobody can predict when the market's going to fall. And a lot of people with the balanced approach say, well, when the market falls, just don't spend as much money. Well, that's a horrible retirement. I mean, I was, I had $1 million, so I'm spending $40,000, $50,000 a year out of it. Now it's down to $600,000 and I'm only going to spend $24,000. What am I going to cut back on?
I owe $30,000 of bills, right?
Or I guess I just won't see the grandkids now. I won't do this, won't do that. No, that's a horrible way to retire. I want to be able to have a systematic distribution that I can count on. And if I give up the idea that my kids will not be quite as rich when I die because I was more comfortable and more satisfied with the income that I had through my retirement, that's what I like. Now, what I've also noticed is that people tend to do better with their growth with buckets as well, because they're not freaking out about a downturn. They don't look at it like, oh, I have to sell everything and go to cash to save myself.
Yeah.
And that's unfortunately there's the financial side of financial planning and there's the emotional side of financial planning. And the buckets really helps the emotional side.
In other words, it keeps it in check?
It helps people because some people will still do the wrong thing at the wrong time. But if you know that you don't have to worry about taking your distribution from the market that just went down 20%, 30%, like it did 2 years ago, March, like it did in 2008, like it did in 2000, like it did in 73, 74, like it does from time to time.
Yeah.
If you know that your current income, the next 5, 6, 7 years, is not in jeopardy, you have the ability to wait it out and you don't sell. On the other hand, if you are looking at your portfolio going down and down and down, and that's where you're getting your distribution from every month, you tend to worry that you're going to run out of money, because taking money out of a down market is a problem. How big of a problem? Depends on how long it lasts.
So if you think of somebody in 2008 who needed an income, but they were taking their income by selling stocks just whenever they needed to.
Well,
and then
if they're taking a
rebalancing.
systematic withdrawal, they're selling it every month.
Right. So they're selling it but you have somebody who doesn't do that and takes their income from another source that's not
dropped in value.
Yeah.
Now, that source that didn't drop in value also didn't earn as much in the previous years.
No, but you probably don't care during a downturn.
And the reality is the difference between a 2 or 3% rate of return and a 7, 8% rate of return over a 1, 2, 3 year period of time is not a huge difference. The difference between a 2 or 3% rate of return and a minus 10%, 15%, where you're still taking money out of it, that's a huge difference.
So you when you got into buckets, I mean, we had a pretty good from about 94, and I don't have the exact stats, from about 94 through, mid 2000. Things
Well, that was the dot-com
we're going pretty well.
Boom.
So what kept you sticking with buckets when you're looking around and you're saying, man, the markets are just going gangbusters here?
Well,
I mean,
gangbusters is one way to say it. Irrational exuberance was what a very highly noted individual called it.
Did you see it that way, though? Or, I mean, did you ever look at this and say, man, a systematic
Well, I looked
at
at the market. I didn't look at necessarily the systematic as much as, this market can't continue doing what it's doing. People are paying ungodly amounts of money for a stock that has absolutely no chance of making it.
Yeah.
Their burn rate was going to burn through all their cash in the next 6 months, and yet we're looking at it, and people are buying it as if it was going to be viable, 10 years from now. It just didn't make any sense that the market was going to continue the way it was going. And people said, well, the old valuation rules don't apply anymore. We have a new paradigm. Everything's different. The world is different.
The new economy.
Buffett was an idiot because he stayed with what he knew, which it turned out to be brilliant, of course. And so we knew at some point it was going to crash. Just like in 2007, 2006, we knew at some point the real estate market was going to crater. When people are borrowing every dime they can get and lying about their income to get loans. So there was a different world back then to be able to get loans. And thinking they were going to be millionaires overnight.
Yeah.
Something had to give. And so we knew real estate at some point was going to drop. In 2000 or 98, 99, even 97, at some point the market was going to give back some of what it had gained.
Taketh away.
And we just didn't know when. The irrational exuberance speech by Greenspan was in 96, I believe.
Yeah, somewhere around there.
We had 3 more years of 20+% returns just by using the S&P.
And with every passing year, he looked more and more foolish.
Right, until 2000, and then he was a genius again.
So for you, buckets was you could see, I guess, the big picture is what I was saying.
When we have buckets, we still had money invested and growing through the roof like the markets were doing.
Well, growing and then cratering when the market
But
hit.
if we were employing all the aspects of buckets, value averaging, taking money off the top when we exceeded expectations, refilling bucket number 1, we didn't have as much money cratering as the typical balanced portfolio. So that was what appealed to me. I didn't have to be Nostradamus. I didn't have to be able to, read the tea leaves and predict when to get in, when to get out, which stock to get in, which stock to get out. I had a much better feeling towards that the clients that we work with would be able to continue their income.
Well, and the funny thing is, I think it took all the way up until about 2008, where all of a sudden you started seeing bucket strategies start to crop up. I mean, it had been there before.
Well, 2005, 6, 7, now the American College, which runs a lot of the training for financial advisors, was teaching buckets. I mean, they had a course on buckets.
Yeah.
Now, and then you see articles on the big websites pop up about buckets. Now, a lot of them I didn't agree with because they said just keep 1 or 2 years in safe money, but then put the rest of it in the balanced portfolio. So their idea of buckets was bucket 1 and bucket 2. Bucket number 1 would last for distributions. If you wanted to take $10,000 a year, you had $20,000 in bucket number 1.
Well, we know downturns tend to last longer than that.
Well, the average downturn is 18 months. Now, the last downturn we had was about 18 days. I mean,
18 hours.
It was pretty quick. I mean, we went from March down to maybe June, and then started recovering. I don't remember the exact dates, but it then recovered by August.
Yeah.
That was a blip, but it scared the heck out of people when it was happening. Back with the COVID scare.
So do you see more people? I see it. Maybe you look around, maybe you have an ear to the ground on this kind of stuff. But do you see buckets being more widely used? I mean, obviously it is way more widely used now.
Right, but when the markets are going up, and they've been going up for a long time, people tend to move away from the buckets because they feel like,
I'm missing out.
I'm missing out on growth. Now, retirees have a different perception of things than younger people.
Yeah.
Because they are taking money out of their portfolio. They need that money to live or want that money to live. So they want that to be, and so they're willing to take a little more conservative stance than, say, somebody who's 5, 10, 15 years away from retirement.
So you're saying retirees don't tend to say, boy, I'm sure sorry that I didn't get 15% rate of return or whatever it is. They're more happy.
I'm in a better situation.
Yeah.
Now, I will tell you, just for the regulators that are listening, buckets won't cure everything.
No.
It doesn't guarantee life will be roses and wonderful. But every time I've run it and worked on it, in the bad times, it has worked better than a balanced approach.
So far,
yeah. I don't know what the history or what the future holds.
We had, wasn't a 10-year downturn, but we saw between 2000 and 2009, that 10-year period of time.
It was a 10-year time.
Where if you had a bucket 3 or if you had a portfolio, your average from that 10-year, where you started and where you ended, you really had almost no gain.
Yeah, very little, except for maybe some dividend reinvest.
Right, but I mean, for all intents and purposes, you really didn't have.
Well, that's why you want to reinvest dividends too. People will say, "Well, I'm just going to strip the dividend every year." There's 2000 to 2009 time frame with the S&P 500. The index by itself had a 0% rate of return over those 10 years. It dropped, and then it recovered. But if you look at the starting point at the beginning of 2000 and the end of 2009, the index was at the same level. Now, if you had been stripping out the dividend every year, you had earned that 2%, 1.5% distribution on the dividend. But if you had actually reinvested that dividend, and I do like reinvesting dividends when you're dealing with stocks. I don't like using dividends to live off of when you have volatile stocks like what we're talking about. You had it wasn't a 10% rate of return, but you had a 3 or 4% rate of return.
So how did buckets fare? And I mean, is because people had their income, even though their stock portfolio potentially did not grow during that time?
The stock portfolios did grow during that time because we were reinvesting the dividends.
Sure, but
we were taking money from areas where we didn't have to spend volatile money, and all the bucketeers that I know of fared fairly well. Now, they didn't have the same growth overall that was projected when they originally set their buckets up in 99 because the market didn't average 10%, but they were still doing fine. They still had their income, and they were still living off of, and they were able to continue their income without worrying about, I need to shut down my income to be able to last the portfolio so that the kids can get something, or so that I don't run out of money.
You said they fared fairly well, not meaning that they went, got 30% rate of return. No. What they got was an income that they could fairly reliably count on and not have to worry about taking a cut in pay because the markets went down.
And they had in most cases, equal to or greater overall portfolio values at the end of the 2009 section than they started with.
Well, that's
even after taking the distributions they were taking at that time.
And so that's kind of why you've stuck with buckets this whole time.
I haven't found anything that works better.
So far.
No, I'm always looking.
I know you are. That's why I asked you, because you're the guy that's always looking around. You're trying to find the better way to do things, but you've stuck with this for the better part of
it makes sense to me. Now,
almost 30 years.
It is harder to do buckets than the traditional balanced approach, like I said before, because it takes management. It takes looking at it. Have we exceeded expectations, which we have in a lot of the last couple of years? Mm-hmm. Do we need to, refill bucket number one now where it's opportunistic, or do we let it run? How do we? And everybody's a little different, so it takes time to understand the individuals. It takes time to be able to evaluate where we are, whether or not it has outperformed, underperformed, what's going on. And the other side of it is people change. Their spending habits change, sometimes for the better, sometimes for the worse. And so we have to reevaluate the portfolio to make sure that works at that time. Because, they start off saying, I want to take $50,000 a year out of my portfolio. I know some clients that we started doing that, 15 years ago. And they haven't changed it. Even though we built in the idea that they can increase that $50,000 a year for inflation, they have had no need to increase it for inflation. Now they're in their 80s and they're just saying, I don't even need the 50 anymore.
We don't spend as much at age.
On the other hand, I've had people set up, maybe let's just say it's $50,000, but they inherited grandkids. They now have to raise their grandkids.
Oh, yeah.
And their expenses go up tremendously, significantly more than inflation, because what they thought they were going to be doing in retirement is nowhere near what they're actually doing in retirement. And a lot of it has to do with unfortunate events where there have been some deaths in the family, and we inherited.
So they've
changed their financial life.
Yeah, and you have some options when you're looking at this, which is why
adjust the buckets.
Which is why it takes somebody who kind of knows how it works. It's not a set it and forget it type of thing.
But even if it was just a set it and forget it, you can't do this monitoring with a computer. Whereas a balanced portfolio, you can set it up that I want 25% here, 10% there, 10, large cap, small cap, mid cap, long-term bond, short-term bond, that boom, and the computer automatically rebalances it for you. And then it raises, $4,000 a month in cash from the whole portfolio
and rebalances
and sends it out to you. You can have a computer do that. But it's not a matter of should you be taking it from the whole pie at that point. Where should you be taking it from?
Yeah, which is what Buckets addresses. Well, that's why I wanted to get into this, and I thank you for the Professor Plum history lesson here. It's a chance for people to get to know who you are and why you're in the financial services field to begin with, and why you believe what you do is you haven't found anything, you haven't changed anything over the last almost 30 years as far as
tweaks, and we've went different. I mean, obviously, things have changed since the 90s.
Right.
The guaranteed rates of return,
you've had to make adjustments to that.
Because what's a money market account paying today? Online is 0.5%.
Yeah.
Woohoo! And back in those days, money market accounts were earning 5%.
But the philosophy stays the same.
The philosophy is the same.
The numbers change.
Do not put yourself in a position that you have to sell a volatile asset when it's in a negative position.
This is what we talk about, and this is what you do every day. If you want some help from Professor Plum setting up buckets, you want to know more about it, you have a bucket strategy already, and you think maybe he needs to take a look at it, or any of the Lucia Capital Group advisors, 800-644-1150. That's the number at Lucia Capital Group, our long-time sponsor of this podcast, 800-644-1150. Any of the advisors can help you out there at Lucia Capital Group. Professor Plum oversees all of the plans, so he takes a look at them and makes sure that they're all correct. You can also go online, luciacap.com, check out our website, and see all the resources there available to you. If you want to read more about buckets, if you want to learn more and watch some videos, there's all kinds of resources, as I said, luciacap.com, luciacap.com. Find us on Spotify, our podcast, subscribe, or do whatever you can to get this podcast downloaded automatically right to your device. You can listen to your heart's content at any time you want. That is so nice. Spotify. I think I covered it all. Next time, Professor, we didn't get a chance to go over some of the limits for 2022 as far as Roth IRAs, and there's some stuff that you probably need to know.
They're slightly changed.
They are slightly changed. And then we had a question about something we brought up a couple weeks ago on the change of the RMD.
Oh, the new RMDs?
Yeah, because there was an article, and they sent it to me, and the article seemed to be so excited that you know, you can defer money even longer if you want. So I want to talk about that. It's probably not as great as they're making it out to be.
We do have new RMD tables. They do create a slightly lower RMD.
Is that a good thing? I mean,
sure. Why
could
not?
be, maybe not. Anyway, we'll talk about that next time. And by the way, a different way of looking at your Social Security withdrawal. It's a different way of thinking about taking your Social Security.
Okay.
I want to get into that next time. And until the next time, my thanks to Professor Rick Plum, Certified Financial Planner Professional, for him and the entire gang at Lucia Capital Group. I'm Johnny Dean, podcast host. Thank you so much for listening. We'll talk to you again next time.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as a receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. It is important to keep in mind that investments in fixed income products are subject to liquidity or market risk, interest rate risk. Bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall, financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Insurance services offered through LPL Financial or its licensed affiliates. California Insurance License Number 0518721. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59 and a half or within 5 years of the date the Roth IRA was established, whichever is longer. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59 and a half may also be subject to a 10% penalty tax. ETFs are subject to market fluctuation and the risks of their underlying investments. ETFs are subject to management fees and other expenses. Unlike mutual funds, ETF shares are bought and sold at market price, which may be higher or lower than their NAV and are not individually redeemed from the fund. Before investing, carefully consider an ETF's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Investment products described herein may not be offered for sale in any state or jurisdiction in which such an offer, solicitation, or sale would be unlawful or prohibited by the specific offering documentation. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. A value averaging strategy does not guarantee a profit or protection from loss. The investor sets a target growth rate or amount on his or her asset base or portfolio each month and then adjusts the next month's contribution according to the relative gain or shortfall made on the original asset base. Since such an investment plan involves continual investment in securities, you must consider your willingness to continue purchasing during periods of high or low price levels. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.